My name is Lara, Sowinski, Group Editor with the CropLife Media Group. Welcome to Tech Hub Live 2025, and this is the start of our Fireside chats. We know it's, 30 degrees outside or so, put a blanket on, come up close, get toasty with us. My first guest is Megan Roberts. She's an ag economist with Compeer Financial. Good morning. How are you?
I'm doing well. Good morning to you.
Thank you. So we're going to run through some big topics here in 10 minutes, which all the more you need coffee for. So I'm just going to pitch these out to you, Megan. And Megan was actually a guest on our Women in Ag Tech program yesterday, Monday, the 21st of July, and she did a great job. She's a master of taking tough things and hard news and smiling and making it seem like it'll be okay. So kind of first things first is consumers and is people in ag. Obviously the farm economy and interest rates in particular, good chance that they're going to kind of stay where they're at. What's that looking at?
Yeah, nothing like interest rates to start a morning off. A very exciting, hot topic for bright and early in the morning. But when it comes to my job at Compeer, I would say the number one thing I get asked about is interest rates and where things are going with the interest rate forecast and then the economy in general. And right now, it really does look like we're in a continued pattern of the Federal Reserve and the Federal Open Market Committee holding where they're at. Anything could happen. So we have a meeting coming up at the end of July in which they'll make their next decision on where they want that Fed funds rate to be held. It's very likely it is going to be a no change situation. And that's what they've done for the entirety of 2025. So we had 4 cuts in 2024 at the end of 2024. That's the equivalent of 1% or so in the Fed funds rate, which then generally should translate over into the interest rates that consumers are paying with their lenders because of some bond market dynamics, extra fun economics there. It went in the opposite direction. So we actually saw interest rates head up during this time in 2024 when the Fed was heading them down. Since 2025 has started, no changes at the Fed, but we have seen some slight downward pressure on consumer interest rates. And then as we move into the end of 2025, there is a projection of 1 to 2 Fed funds cuts that might happen. That would be the equivalent of 1/4 to 0.5%. Have I said the word percent too many times now? I think so.
I'm writing it down as you say. So the other thing we kind of prepped about and talked about, and this is something that is truly a little bit foreign to me, but grain marketing signals, what you're seeing there, I think you kind of suggested a lot of uncertainty in that sector as well. Tell us a bit about that.
Certainly. When it comes to the ag economy, if you're working in agriculture, you likely know it is not necessarily the best grain market prices right now. We have some challenges on the corn and soybean side for pricing. And we had at the very beginning of 2025 some grain marketing signals that pushed prices higher. We had a stocks to use ratio in corn that pushed that supply and demand curve to a higher price, and then entered some uncertainty. We didn't know exactly what was going to happen with trade policy. We still don't know exactly what's going to happen to trade policy. We really have to look to August 1st to understand. And we might not even know on August 1st what trade policies are going to be. And since then, those supply and demand fundamentals have changed just a bit to the lower as we've moved through this 2025 planting season. We have historically large corn acres. The USDA is projecting that 181 bushels per acre as a forecast yield. That would be a lot of corn. And so it is likely to be a continued challenging year into harvest for corn and soybean prices. Okay. And so what does that mean for the farmers that everyone is working with? They have a limited amount of profit potential as they move into harvest season. And so every dollar they have to be spending it the best that they can. And so as a provider of agricultural services, I always think in those years, you have to do even a better job of showing that value, because every dollar matters in those really tight years.
And that's not necessarily a bad thing, of course. Sometimes
sometimes it forces you then
really,
to make those hard decisions and determine what technologies are you going to use. Maybe it is an argument to incorporate a new technology if that technology for that farmer is going to save them time or money. And I don't think I shared here today, but in addition to being an ag economist, I live on a corn and soybean farm. My husband farms full time. I farm when I can in the evenings, on weekends, that sort of thing. And so I make these decisions on my farm as well. If I'm incorporating a new technology, what's the ROI? And in a tough economic time, I need that ROI to be faster. It needs to pay very quickly.
Yeah, so, I mean, just, I guess the takeaway, obviously a little bit this uncertainty, if you will. I mean, it's here to stay, at least for the short to medium term, right? The next 12 to 18 months.
Absolutely.
What other things other than, like you said, being more discerning about where you're putting your money, demanding more in terms of ROI, a quick ROI, a measurable ROI. What other things? Like how can we get through this? I mean, we'll get through it, but what else you seeing? What else can you advise?
I go back to the basics of looking at that cost of production, understanding where break even is, where is that extra cent or dime that can be gathered from a bushel of corn or a bushel of soybeans. How are you showing to, whether you're the farmer and you're doing the analysis on your own farm, how am I getting the best use out of the technologies that I'm using, the best use out of my production? Or if you're on the service side and you're providing services to farmers, and making those arguments of gathering those extra pennies where you can, because that's what gets you through the tough times. The good managers, they live to farm another year.
Yeah. I'm curious, and like I said, a little bit coming off the Women in Ag Tech program, talking a lot about ag tech here from the farmer and retailer perspective. As an ag economist, just curious how you're using AI and tools in your forecasting and your analysis. What are you doing on that front?
Certainly, there are AI and tech tools that are used in economic forecasts. I am going to be a little bit contrarian here and say that I use AI a little bit less than some of my colleagues. And it isn't because I don't want to use AI, it's that it is sometimes not very good at reading USDA documents. So the USDA, if you look at a lot of USDA reports, they are all formatted very differently. And AI doesn't do a good job of reading things that aren't in the same format. It also tends to take whatever number is repeated the most frequently. So if I ask it, what is the World Agricultural Supply and Demand Estimate corn price, it is going to tell me whatever was most repeated as the corn price. So it might be the January, talked about in January, we had some supply and demand signals that pushed up those corn prices, and we saw this uptick in corn prices, and so that got reported on a lot. And so it still is telling me the January price when I want to know what the July price is. And I think it's learning, because it's getting a little bit better. I've noticed some improvements just from January to now, but because I have to do regulatory reporting using USDA numbers, I would need to spot check every single thing. And so I use it not as frequently as one might suspect, but it might be that it still needs to learn. I'm talking about it like it's a thing, but it sort of is a a thing that is learning and a sentient being. And so I hope I can use it more in the future.
I love the honest reply. I appreciate it. Megan, thank you so much for joining us. We really do appreciate it.
Thank you so much.